All right, so good evening. It's June 17th, 2012. Ken Long from Tortoise Capital with a review of the weekend reports. Get started on page one here. We have a market that's still in bull volatile conditions. 53 out of 100 on an annual basis using weekly RSI 14. On a 10-day basis, we're overbought at 98 out of 100 on the 10-day NDX. Percent stretch relative to the 200-day moving average is at 4.23%, so that's coded as white and bullish. So basically have still held after bouncing off the 200-day moving average a couple weeks ago. The slope of the 50-day moving average improved a little bit to minus 0.57%, but that's still coded red bearish. ADX has declined to 21.8 and about a toss-up now between the bulls and the bears in terms of strength of trend. The volatility percentage at 1.60 remains high, highly volatile compared to the last 100 days. The ETF2 model is still at 0%. The model portfolio is at 50%. The blended monthly rebalancing is still holding TLT, SHY, and another scoop of SHY. That's the next rebalancing is due on or about 1 July. Next up, we'll take a quick look at the blended monthly portfolios. There we go. Let's have a slow connection tonight. The 13 ETFs, it remains long-term treasuries, U.S. real estate are the only things on a buy signal and in the green, followed by the rest of the U.S. led by tech. So no change there. In the 26 ETF portfolio, the only three that are on a buy are long-term treasuries, U.S. real estate, and emerging market bonds. And then SHY, the short-term treasuries, are on a buy as well. But everything else is cash. But it's dominated by the U.S. at the expense of commodities and the globals. So no change over the last 3 or 4 months in that regard. Next up is the world market model. The market health check, excuse me. Let that come up on your screen. All right, the vertical blue lines represent 10, 20, and 30 days worth of look back. The horizontal purple lines are price targets that have acted as resistance levels before, and we're touching this one now here at 134. We get this little series at 134, 135, and 136, which are all clustered right around that 5% off the top of the swing high from 142, and which had held as support levels prior. So we're getting ready to test that little cluster right here. And that 135 also corresponds with the upper edge of the Bollinger Band. So really, for us to think about this as a recovery here and as a chance to test 142, the first thing we need to see is this a close above 136 to get through these 3 price levels here. Last time it tested 134, it failed sharply. Time before that, it failed sharply. Time before that, it failed sharply. So maybe this is on the 4th time will be the one that comes out differently. If so, this will be seen as a inverted head and 2 shoulders pattern, and then the price target after 136 would be, in my view, about I would say 141 or 142. You can see I've highlighted in red here, light red, the boundary of the 200 period moving average. And you can see how much the river has pulled back and where we bounced off the 200 a couple weeks ago. Right now, market is still overbought. The jaws of PPO have opened from underneath the zero line and still pointing up. That signal occurs, that crossover occurred here pretty early in this move, right around 129.5. So there's reasons to pay attention to that intermediate term signal. And it's still open and getting wider, so that's still a positive sign on the for the bullish case. You can see how ADX has rolled over on the top here. It's come down from 35 down to about 20, and actually the bulls are slightly in front of the bears at this point, but not enough to reverse the slide in ADX quite yet. The slope of the regression line, that's this blue, the black line in the middle, is still pointed down, not as bad as it has been, however. And you can see the channel formed by the maximum excursion from the regression line here in the two outer black lines. And I've projected that channel forward to show where price ought to go unless there is some kind of underlying change in the fundamental truth about the market right now. So we're getting ready to test that here at 130, 135-ish. So normal channeling behavior would be for it to reject this price level here and come back towards the mean at about 129-ish. All right, moving on. Next up is just a review of the 10 primary indexes of the world market model for ETF2. That should come up on your screen in a second. And as you can see, they're all still on a cash posture. SPY at 73 is still better than the globals of EFA at 61. So it's still the U.S. dominating. And inside the U.S., it's technology, then the spiders. Now the small caps just edged out the mid caps for third position here. But still, tech and SPY are still leading the way, and the two weakest remain Latin America and emerging markets. Now the next one up is the world market model. For the first time in a long time, we've had some actual weakness creep in here to the U.S. market. You can see mid caps across the board are now slightly below average, as our small cap value. Only the large caps, including the tech, and then the small cap blend and growth are above average. Weakness still in Asia and Asia less in Japan and Asia less Japan. The winners continue to be Malaysia, followed by Singapore. Weakness across the board in Europe and in all the countries of Europe except for Belgium. See the weakness in Spain. Brazil and Latin America both well below average in the Western Hemisphere. Strength in U.S. real estate, corporate bonds, and treasuries. Gold has started to do a little bit better here. You can see in the global business sectors that the defensive plays of staples, utilities, healthcare continue to do well both in the U.S. and globally. Weakness in the basic materials, basic industrial sectors, and finance. The ETF Top 30, based on the ETF2 database, dominated by The defensive plays like the U.S. large cap sectors that feature utilities, consumer staples. That's the XLU and XLPs of the world. Meanwhile, it's biotech and lots of real estates, healthcare, couple more real estates, dividend selects, real estates, bonds, real estate, large cap dividends, real estate. So you can see where this is heading. It's the dividend payers in a world that is very concerned about Europe right now. Among the Dow 30, using the same lens now as the blended monthly rebalancing. Let that come up on your screen, and we'll see. We will see that it is the consumer staples that are continuing to win: AT&T, Disney, Walmart, Home Depot, Verizon, Coke, Travelers. At the bottom remains the producers and basic industries and financials: Caterpillar, Hewlett-Packard, J.P. Morgan, Cisco, Alcoa, United Tech. I'm still intrigued by McDonald's being weak, so I continue to stock them as a value play. Next thing up we're going to look at is the volatility stat. And little to no change here. Volatility has stabilized at about this on the standard deviation bar. This is about the same as 1.6% on ATR percentage. This is right at historical norms. You can see, looking back 10 years, or 5 years, excuse me, we're right back to about the midpoint of the norms. Right, moving on. We're going to shift now to the daily. There we go. I'm going to reread the top bar to you. In the overreaction system, we have 3 short signals now. These are among the weak globals. This little bounce this past week has set them up for a short on weakness. You wouldn't be wrong to wait to see them violate below Friday's low of the day before you went short them. But the short side signals are clearly there. The Euro-Asia Blend EFA, emerging markets, and European 350. You can see how volatility has moved almost 2 full standard deviations above the norm, which was right around 1.1, and the decline in ADX and trendingness. No patterns to speak of from Friday, and that's not unusual when you consider the 2-to-1 requirement for most of those patterns, 2-to-1 based on a retest of the 10-day high, because the market's done had a bit of a recovery these last 10 days, and it's close to the 10-day high. There just aren't that many 2-to-1 frames that are available. The ones that you do see, however, Treasury, silver, the VIX, oil, Caterpillar, and blended commodities. Those remain available on the basis of the auto framer, for example. Move on. Next up is the Dow Tactical Summary. We have only a handful of dojis to consider. Let me let that come up on your screen. I have 3 dojis in Travelers, 3M, and ExxonMobil. And then the no patterns per se, only one testing out at better than 2-to-1 on the auto framer. That's Caterpillar at 2-to-1. What I like about Caterpillar is it tests at 2-to-1. It has a strong frog quality number, and it's been bad 1 month, 3 months, and 6 months, as you can see by the red on the percent changes, but now has actually started to recover. So that could be a value opportunity in my view. The top 5 max pain range compressions: Procter & Gamble, Kraft, Walmart, IBM, and Hewlett-Packard. Moving on. Also, some dojis among the ETFs. Have oil and mixed commodities, gold, silver and natural gas, and U.S. real estate. Now, U.S. real estate should be of interest for you, since it's been one of the leading candidates for equity strength in the last 2 months. There we go. So you can see the dojis in column 1. Won't repeat them. 4 candidates on the auto framer: silver, oil, long treasuries, and the VIX. And you can see the top 5 max pain range compressions. Still quite a few are doing better than 3-to-1 on frog quality number here, and we do have one that had an RSI2 closing of less than 10, meaning it was at the fourth percentile in terms of its daily range is where it closed. That's how you read that. And that's DVA, the agricultural ETF. Okay, moving on. Looking at the market mosaic charts next. You can see the 30-period regression line is still sloping downward, but there's been a counter rally move against that, and that's part of the reversal in fortunes here based on the regression line we've seen over the last about 5 or 6 days. The crossover occurred at 2 standard deviations below the norm that was back here, where if it was going to fail, it should have failed, but it didn't. So now price is fighting its way north. You can see it still has a long way to go to get back to previous extremes on the upside. A nice bounce has been put in, looking at price with respect to the 200-period moving average, and that's what that dotted line represents, is the 0 line. That's the actual distance to the 200-period moving average. So it came down, found support, and it's now moving up. It has some definite head and shoulder qualities to it. You can see the last head and shoulders we had back about 5 months ago was a precursor for a really nice move. That's sort of the rationale for paying attention to that chart pattern and being ready to work in either direction. Next up is a quick look at the z-scores of the regression lines. And you can see now the 30 has, it got down as low as that -2 at the same time that the 10 period had reached an extreme at about 1.5. The 10 period got better. The 30 period has bounced to get back inside the normal channel, and the rate of decay in the 90 period has started to slow. The 10 has a z-score of just about 1.0, so it's still at the upper end of normal. Still some room to go in this little leg up here, since it hasn't even gotten back to the 0 line yet. And you can see that the compared to the Bollinger Band here, this is on the bottom chart, the green and red lines, that's the plus and minus 1 standard deviation Bollinger Band on the 30, and price has now found a bottom, entered the river, crossed the river, and is now at the far shore and now this is a normal place for it to begin to fail back towards the median, which would keep it in this red and green channel I've portrayed here and in line with the river. However, a breakout from here is we have to see a price above 136, and then it's reasonable then to expect a move to the top of the swing high up here around 141, 142. So still plenty of room for the 30 period to go. This is starting to look a little more favorable. Let's see. I think that's everything I want to look at on the daily. I do want to take a look at some other charts just from earlier in the week. And this is just to put some language to some visuals that we had on frog intraday moves. So let me open that up. All right, this is part of a larger research project I've been doing on the frog in preparation for our first frog trading workshop, or I guess we'll call it I hate to call it a boot camp, but it's kind of what it is. It'll be lots of practice on trading the frog. So I want to get some background on the kinds of moves that we're trying to gain. This is just looking at the last 200 days. 200 trading days, and it represents the dollars of range from the low of the day to the high of the day, and broken out simply into 4 quadrants. So you can see all the first quadrant goes out 50, the 50 least volatile trading days. It was anywhere from about 50 cents to right about $1. The second quartile goes from about $1 to $1.75. Third quartile, $1.75 to about $2.20, and then the fourth quartile from about $2.20 all the way up to over $5 of intraday range. Oops. All right, now to take a statistical approach to that, what we can say is now the average move was a $1.76. The standard deviation about 87 cents. The 25th percentile was down here about 1.02, but you can see the lowest, more than one standard deviation below average comes in this tank. And when you apply stats, what you see it's not a normal straight linear progression, but you have wider middle. These are not quartiles, but middle ranges between the 25th and the 75th percentile. So plus or minus one standard deviation is what I'm trying to say. So much wider agreement here on the average ones, but then you got, this is typical of like a binomial distribution where you're more tightly clustered around the mean, and then some fat tails. And the nice thing on the frog is that the fat tails are things that move in our direction that tend to be very clear directional days, moves in one direction with no looking back. And those are the days that you really get rewarded in the market. Now this next chart takes a look by putting the colored bands now are standard deviation steps, if you will. And so when the follow-through is less than one standard deviation, there's only 12% of the time, only about maybe actually about 13%. These are the times when there was less than one standard deviation move from the low or from the open of the day, and so there are days that you don't get any entries. So there's about 88% of the time you're going to get a move greater than 1 standard deviation. So 9 out of 10 times there will be a trade signal in SPY. 32% of the time the move afterwards nets out to less than a full standard deviation. And what that means is there's going to be about 1/3 of the time you can expect to get fractional trades, fractional wins, fractional losses. And then 56% of the time you're going to have moves that are more than 2 standard deviations. And then as you move further to the right, the chances that those become directional days is greater, that the market is moving in one direction and it becomes a dominant theme. And those are the days when you get really good moves in the frog. Now, if you're concerned about win rates and all that stuff, looking at the large number, I would say these 32% that move not quite an additional standard deviation. Well, on those kinds of days, you're tempted to say in retrospect, man, I wish I had taken that half a standard deviation move in my favor and not letting it go all the way back against me. But then you realize that 2/3 of the time, twice as many times, it's going to move more than that full standard deviation. And that's the argument to keep half the position on after you cash your first standard deviation win, because you have all of these days where there is a potential larger trade available than simply taking the target at 1 standard deviation. So that's sort of what this logic is intended to show. There were a couple days out of the last 200 where, of course, you had 1, 2, 3, 4, 5, and 6, as many as 6R kinds of trades or 6R moves that were available. And again, the further out on the tail you get, the more likely it is that you have a directional day. This is just a little histogram that takes a look at, now this one goes back 10 years and considers what was the average range percentage of each of the 30-day periods of the last 10 years. So that's the N on this one is about 2,600, because that's how many 30-day periods there are in 10 years. And what you'll see is you have the most of the time between 1 and 1.5% out here to about the 60th percentile. But then about 40% of the time, the average percentage gets way higher. So anytime the average range percentage gets bigger than 1.5%, then what you've got is a consistent period of expanding range on a relative basis. But really what we can say the long-term norm is at about 1.5% intraday range. So if you're trading SPY, that's something that you should know. Now this next one is interesting because it takes a look at the z-score of daily follow-through. So I compute going back, it computed the standard deviation of each of those days in the last 10 years. And then on the basis of the frog quality number, took a look at, and on the basis of the standard deviation too, just said what was the size of the next day's range based on today's standard deviation. And what you get is something with 40% of the time, well, actually 3% of the time you only got between 0 and 1, and those are the times when you get not much. You may not even get a signal. So the historically, over the last 10 years, the chance of you not getting a signal is pretty small. The last 200 days of action, because we saw in that one chart, 12% of the time you didn't get a signal in the last 200 days. That's actually relatively quieter when compared to the 10 years, where only 3% of the time did you not get a signal. And then what you have is the possibility then of fat right tails. And again, I'll just keep bringing this point home, is that the the greater the size of the range, the more directional kind of a day that you can see that it was. And this also makes the argument that if you get a 1 standard deviation move, which causes you to trigger and enter, and then you get a reversal, you still want to stay in that trade and take 1 or 2 signals because of the great possibility of how many days there are where you have these larger standard deviation based follow-throughs, including a couple that are out here at 11 and 10.5. So you can get some extraordinary days in there. This 11.5 sigma one was that was the flash crash right there. You can see it past 11 sigma. Next thing I did was I wanted to take a quick look at at how the frog quality number of SPY varies over time. And so this goes back 10 years and computes the daily frog quality number, and you can see this thing tends to oscillate. I would also have you notice that in the last about 3 years, the size of that oscillation has been really extraordinary. A combination of changes in ranges and shifting nature of volatility accounts for that mostly. This earlier pretty tight constraint reflects a slow grinding slow grinding bull that came out of the 2003 bottoms and then just slowly ground north. And now what we got is just much wider swings in frog quality number and changing nature of markets, I think, due to digital trading and high frequency trading. That is my intuition. So now if you take if I just try and calibrate that, just take that 10-year data, we can say that the frog quality number, the average over the last 10 years, is about 2.6, 2.65. And then with the standard deviation, plus or minus 1 standard deviation gets you about 3.2 and about 2.2 as well. So the standard deviation is about 0.5. And where we are right now is we're right at about 2.5-ish right now after an extreme period. So we've gotten some increased volatility the last 2 to 3 weeks that has an increase in volatility without an increase in range per se tends to give you this this characteristic where frog quality number gets worse. Moving on. I then wanted to take a look at what happens to, this is just over the last 200 days now, and what kind of follow-throughs do you get based on what the frog quality number is. And so it just seems to me, just by inspection, I haven't run the correlation coefficient on this yet, that anytime when the frog is above the average line, the size of follow-throughs seems like it gets larger. And lately, we've had some extraordinary directional days in here, and not many very quiet follow-through days. So I think if we just took a look at that regression line, what you'd see is the frog should be coming back into play as you're starting to get more follow-throughs. There are some periods of time in here where you're not getting much follow-through at all. But as let me put that back on. In this period here, you're getting very little follow-through. That's the kind of a market when you have low frog quality numbers. There's not much follow-through. But guess what? If you restrict yourself to trading when the frog quality number is above 3, you're going to get much better follow-throughs. Or actually, in this case, in SPY, because it so rarely gets above 3, I'd say anytime it's above average, you want to be playing the frog, because you can see when it's above average, you're getting much bigger follow-throughs. And I think that has a function to do of normalizing volatility. When it gets quiet for a long time, then the frog quality number is going to get better because the standard deviation gets smaller. You're getting reliable range moves. And then on days when the you do take positions when the frog quality number is high because the standard deviation is low. You end up getting your biggest follow-through days on those kinds of days. So that's sort of the argument for the frog, especially when it's quiet. And then this one just this one zooms in right now on frog quality number of the last 180 days. And this is going to be an indicator that I add in here to the daily pretty soon because of the insight that whenever frog quality number is above average, I think you want to be postured to take advantage of moves. And so this is one of those times when the frog should be doing well because the average range is increasing. That's how I read that. Okay, so that's a quick look at some frog research and a quick look at a new indicator I'll be putting on the dailies. And I'll be sharing some more with you as I add more to the frog workshop. And that's basically all I have for you today. And a little shorter than usual because of Father's Day. We got some German chocolate cake that my daughter cooked that we've got to eat. So that's up next. Anyway, that's all I got from here. I hope this finds you well and enjoying your Father's Day. And thanks to all the fathers out there for all you do and what you've given to us by raising those excellent kids of yours. So take good care, and we'll catch you in the chat room.